All right, let's dive right into this. Welcome back to The Explainer, everyone. So, if you're a beginner investor, or honestly, even if you've been at this for a while, there is one universal truth you're eventually going to face. The market will drop. Sometimes it drops hard. It's scary, it's stressful, and frankly, it can make you want to just hit that sell everything button right on your phone. But today, we are giving you a specific, structured plan. Think of this as your crash survival playbook, completely focused on how to maintain your discipline when those inevitable market downturns actually hit.
So we've broken this playbook down into an easy, sequential checklist. It's basically an emergency procedure to shift our mindset from fear to long-term rationality. First, we'll quickly unpack the anatomy of panic. Then we get into the actionable steps. Step 1, unplugging the noise. Step 2, reviewing your goals. Step 3, remembering the math. And finally, Step 4, automating and holding.
Okay, starting with section 1, the anatomy of panic.
Look, before we can fix a behavior, we kind of have to understand it, right? When you open your portfolio app and you just see a sea of red, that emotional gut punch you feel is completely real. Behavioral finance actually tells us that the fear of losing money is a deeply ingrained human instinct. We literally feel the pain of a loss much more intensely than the joy of a gain. And that intense pain, it leads us straight into panic selling. That happens when you sell your investments incredibly fast, just because the market drops, the news sounds terrifying, and you just desperately want the bleeding to stop. But here is the absolutely crucial takeaway. When you sell during a crash to try and stop the loss, all you're really doing is taking a temporary on-paper dip and locking it in as a permanent, real-world negative return.
Then there's another major psychological trap we fall into, and that's herd mentality. When everyone around you, on social media, on the news, in your friend group, is panicking and selling, your brain literally screams at you that you should be doing the exact same thing. You just follow the crowd instead of trusting your own financial plan. But remember, during a downturn, crowds are reacting purely on emotion, not on rational data.
And this behavior has some pretty devastating ripple effects. First off, you almost always end up selling at the absolute lowest point, locking in those losses. Second, and honestly, this is a huge one, you completely miss the inevitable market recovery phase. Markets historically bounce back, but if you've already sold, well, you're just sitting on the sidelines when those prices go back up. Third, you completely derail your carefully crafted long-term wealth building. And lastly, you're building a really terrible habit. If you panic sell once, you are essentially training your brain to do it the next time the market gets a little bumpy.
Moving on to section 2, which kicks off our action plan with Step 1, unplug the noise.
So how do we actually stop this cycle? Well, when the market is crashing, your environment becomes completely toxic with bad news. This very first action step is all about tackling your immediate behavioral triggers so you can get control of your decision-making back. Think about emotional investing as a state of chaos. You're hyper-focused on your feelings, you're probably binge-watching negative financial news, and refreshing your portfolio balance every single hour. Rational investing, on the flip side, is quiet, structured discipline. You're focusing on the raw data, you're relying on a pre-decided plan, and you're actively limiting how often you check the market. In times of crisis, inaction, just doing absolutely nothing, is very often your best possible move.
So the fundamental rule for step 1 is super simple. Avoid constant market watching. It is honestly the ultimate cure for immediate market-induced stress. Delete the investing app right off your phone's home screen for a week if you have to. Turn off those financial news networks. Just stepping away from the continuous barrage of red arrows is going to immediately lower your anxiety and stop you from making a hasty, emotional trade you'll regret later.
All right, section 3 brings us to step 2, review your goals. Once you've stopped the bleeding by turning off all that noise, you can transition into reviewing your goals. We want to pull your focus completely away from the panic of the present moment and cast your eyes way out toward your long-term time horizon. Ideally, you should be structuring your money across 3 different horizons. 1 to 3 years are short-term goals. Think emergency funds. And honestly, money you need this soon shouldn't even be in the volatile stock market anyway. 3 to 7 years are medium-term goals. But look at that 7+ year category, retirement and major wealth creation. If the money in your portfolio is designated for a goal that is over a decade away, a market drop today literally does not matter. Matching your investments to these specific horizons is exactly what prevents short-term drops from derailing your long-term wealth.
I really love this quote from our sources. When you know why you are investing, market fluctuations become easier to handle. I want you to internalize that. Your why, whether that's achieving financial independence, a comfortable retirement, or maybe leaving a legacy for your family, that is your anchor. When the economic storm gets really rough, having a clear, structured goal is what keeps your ship from blowing off course.
Let's move right into section 4,
Step 3. Remember the math. So let's see how this all builds into undeniable logic. When emotions are running high, cold, hard data is just the perfect antidote to soothe your anxiety. And the core concept here is compound interest. Simply put, it's the interest you earn on your interest. One of our sources actually features an 18-year-old asking for investment advice, and the advice given to that beginner is completely universal. Starting early and letting compounding do its work is essentially mathematical magic. It turns small, kind of boring, consistent contributions into massive, life-changing wealth, provided you just give it enough time. And here is a fantastic mental shortcut to help you visualize that compounding. It's called the Rule of 72. If you ever want to know roughly how long it takes for your investment to double, you just take the number 72 and divide it by your expected annual interest rate. So, for example, if you expect a 9% return, 72 divided by 9 is 8. That means your money is going to double every 8 years. It's such a brilliant way to instantly conceptualize the power of your investments over time.
Visually, you can really see how patience pays off. Take a single one-time deposit of just $100, growing at a very modest 5% compound interest. It's $105 in year 1, but look out at year 25. It's grown to $340. And that is the power of compounding without adding a single dime to the account. The interest is out there generating its own interest. All you have to do is leave it alone.
Now, 5% is obviously a fairly conservative example. For some real-world context, our sources note that historically, over a 20-year period, India's Nifty 50, which is an index of top blue-chip stocks, has actually delivered a compound annual growth rate, or a CAGR, of about 12 to 13%. When you plug that kind of percentage into the compounding math, the results are pretty staggering. To put that into perspective, an initial investment of 1 lakh at a 13% CAGR grows to about 1.84 lakh over 5 years. But fast forward to the 30-year mark, that exact same 1 lakh transforms into roughly 39 lakh. It multiplies nearly 39 times over. This brilliantly illustrates the crucial point. When the market drops by 10 or 20% this year, you have to realize that interrupting this massive 30-year compounding process by panic selling is literally the biggest mistake you could ever make. Which leads us perfectly into Section 5, our final step. Step 4, automate and hold. We've fixed your mindset. Now we really need to fix your mechanics. We want to give you a tangible mechanism to lock in your discipline so you don't even have to think about it anymore. And the absolute best tool for this is the SIP, or Systematic Investment Plan. An SIP automatically invests a fixed amount of money on a regular schedule, like every single month. Why is this so powerful during a crash? Because of something called rupee cost averaging. When the market crashes and prices are super low, your fixed monthly contribution automatically buys more shares on sale. It completely removes your emotional hesitation because the system is just doing the buying for you. It is your portfolio's autopilot, flying you straight through the turbulence.
Furthermore, what you're actually holding matters a lot. Our sources highlight that a well-structured portfolio should be heavily anchored in quality. A really solid foundation holds roughly 65% in high-quality blue-chip stocks, like those you'd find in the Nifty 50. Blue chips are the largest, most established companies out there. Historically, during market crashes, these high-quality stocks fall far less than smaller, riskier stocks, and they tend to recover much faster. They provide that baseline stability that makes it so much easier for you to just hold your ground. Okay, let's bring this whole shebang together. Here is your definitive crash survival playbook. Number 1, unplug the noise and stop obsessing over those ticker prices. Number 2, review your long-term goals to remember your true why. Number 3, trust the math of compounding and the historical reality of market recoveries. And number 4, automate your investments with SIPs and simply hold onto your high-quality assets. I want you to mentally file this 4-step checklist away right now for the next time the market gets choppy.
I want to leave you with this powerful thought to anchor you. Avoiding panic selling is not about predicting the market. It is about controlling your reactions to it. You can't control the economy, you can't control interest rates or global events, but true financial power, that comes from your internal discipline. Your rational behavior is, without a doubt, your greatest asset. So, I leave you with this question to ponder. Next time the market drops, and trust me, it will drop, are you going to give in to the herd mentality and panic, or will you stick to this rational playbook and prosper in the long run? The choice is entirely in your hands. Thank you so much for joining me on The Explainer today. Keep learning, stay disciplined, and I will see you next time.